they are in a very strong position. And, I think the fact that they haven't actually gone onto a gold standard yet is because India doesn't want it. The Chinese have a different approach to this sort of thing. As far as they're concerned, they don't want to rock the boat. They don't want to be blamed for collapsing the West and so on and so forth. But as soon as someone like Russia goes on a gold standard, we are toast. I mean, it's as simple as that. So, and they're also talking about this. I understand that, the agenda for the BRICS meeting in, where's it, Astana or wherever it calls itself, back in October, the Russians are going to be putting, or they're going to attempt again to put the trade settlement currency backed by gold. Presumably, I mean, the word is a mixture of gold, 40% gold, 60% currencies. But they'd have to go onto a gold standard. I mean, this is the point everybody misses. So we could well have gold standards throughout Asia by October or shortly thereafter. This is an interesting situation. The problem with this, of course, is that, quite some time ago, I saw a statistic that 70% of the employed workforce lives paycheck to paycheck. In other words, they don't have any savings. They can't put anything aside. And that makes it even worse because, rising interest rates, rising mortgage rates and all the rest of it, it's already squeezing them very, very badly. I mean, as to your point about people getting behind on their mortgage payments, it's going to become a question, I think, of, individuals are going to have to manage the relationships with their building societies and all the rest of it. I mean, building societies and banks, as you rightly point out, are going to be constructive on this. I mean, it's the old story, owe £100 to the bank and, you've got a problem. Owe £1 million to the bank and the bank's got a problem. That's really what that's what it boils down to, with everybody being in the same boat. They're going to, the way to manage this is don't just, but get into a dialogue with the bank, because the bank or the building society will recognize it's got a problem. It will not want to foreclose. That is the last resort. And, when this begins to snowball into even greater numbers, it's not even going to be a last resort. The whole system will have to be underwritten by the government, in effect, that, of course, leads to the dilution of the purchasing power of the currency. I mean, the liabilities coming down the road are just increasing all the time. But this is, if you're going to keep the roof over your own head, I think you're going to have to think seriously about your relationship with, your bank, your mortgage provider, whatever. But that is rather beyond us. I mean, we're just talking about an economic scenario which we can already see is beginning to arise. But for those who can afford to do it, who don't have these obligations, I think there is an increasing urgency in order to get out of credit as much as possible. And credit is not just a bank deposit. I actually don't worry about bank deposits. I mean, you've got money, if you've got currency sitting in, say, NatWest Bank, which is half government owned anyway, that's not going to go bust. They're going to do anything they can to stop banks going bust. Let's face it. So, but the problem is the currency. The currency is credit. It is an obligation which is owed to you by the central bank. Now, I mean, I have economists, even Austrian economists, who don't actually understand that point. They think that the currency has actually replaced gold as money, and consequently, they ignore the fact that there is a balance sheet entry on a central bank's balance sheet, which shows currency as a liability. A liability to who? To you and I, to the extent that we own the currency. So that is credit. It is credit with a counterparty, and that counterparty is going to dilute your currency because of the obligations which that counterparty now has. This is going to be, it's whichever way you go, it is destructive of fiat currencies, and it is the ending of the fiat currency era hoving into view.
The problem with our current economic scenario is multifaceted, and it's exacerbated by the reality that a significant portion of the workforce lives paycheck to paycheck. A recent statistic indicated that 70% of employed individuals fall into this category, meaning they have no savings and can't set anything aside. This situation becomes even more dire when interest rates and mortgage rates rise, squeezing these individuals even further. When people fall behind on mortgage payments, it's crucial for them to manage their relationships with their banks or building societies proactively. Historically, banks prefer not to foreclose unless absolutely necessary. They recognize that widespread foreclosures would create systemic problems. Therefore, maintaining an open dialogue with your financial institution is essential. This approach can often prevent foreclosure and may lead to more manageable repayment plans. The broader issue, however, is the currency itself. Currency is fundamentally credit and obligation owed by the central bank to the holder. Many economists, even those from the Austrian school, often overlook this fact. They mistakenly believe that currency has fully replaced gold as money, ignoring that currency is a liability on the central bank's balance sheet. This misunderstanding is crucial because it underscores the inherent risk in the inevitable dilution of purchasing power that comes with fiat currencies. We've seen the consequences of such policies in the past. For instance, during the apartheid era in South Africa, despite severe international sanctions, the inventive and resourceful population developed new technologies to circumvent these restrictions. This adaptability rendered the sanctions largely ineffective. Similarly, Russia today is unfazed by losing access to US dollars, viewing it as an opportunity to signal to their global partners the unreliability of the American financial system. The shift away from the US dollar is gaining momentum. Nations representing 60% of the world's population and 35% of global GDP by purchasing power parity are increasingly wary of American hegemony. This shift is driven by the desire to escape the perceived colonialism of the West and seek alternative economic systems, often centered around commodities and gold. The end of the fiat currency era seems to be on the horizon. Countries like Russia and China are positioning themselves to adopt gold standards, which would dramatically alter the global financial landscape. A gold standard ties the currency to a physical commodity, limiting the ability to print money indiscriminately and thus preventing hyperinflation. For Russia, this move would attract international investments, as foreign banks could buy gold at lower rates and sell it at higher returns within Russia, effectively earning interest in gold. This strategic positioning by Russia and potentially other BRICS nations could destabilize the fiat currency system dominated by the US dollar. If Russia implements a gold standard, it would likely prompt other nations to follow suit, creating a domino effect that could lead to a significant revaluation of gold. The BRICS nations have been discussing the creation of a trade settlement currency backed by gold and other commodities. Such a currency would provide a stable and reliable means of international trade, free from the volatility and counterparty risks associated with fiat currencies. This potential shift towards a gold-backed currency highlights the growing discontent with the current financial system in the search for more stable alternatives. The potential for a gold standard in Asia by October or shortly thereafter is an exciting and transformative possibility. It would signify a return to a more stable and reliable financial system, anchored by the intrinsic value of gold. This move could also spur increased investment in gold, driving up its value and solidifying its role as the ultimate store of wealth.
As we discovered with South Africa in the apartheid days, when the world introduced sanctions against South Africa, the inventive people in South Africa developed new technologies and everything to get to deal with the problem, and the sanctions just didn't work. I mean, it just hit everybody else, and this is exactly what's happened with Russia. Now, I actually don't think Russia gives two hoots that they've lost all those dollars. I mean, because the US has defaulted on its obligations. Let's face it, that's what's happened. They'll make a bit of noise about it. Of course they will. But from the Russians' point of view, this is sending a signal to all their partners, and we're talking about 60%, or nations representing 60% of the world's population now. 35% of the world's GDP by purchasing power parity. That the Americans, basically, they will steal from you. And a lot of these nations also know that unless they kowtow to the Americans, there might be a revolution or, some sort of regime change forced upon them or whatever. So, I mean, there is a fear of the Americans, but that fear is being broken now by the fact that Russia, in conjunction with China, are if you like, a viable home for all these nations who are, sort of, if you like, sick of the colonialism, if you like, of the West. The difference between a fiat currency and one which is actually on a gold standard. The fiat currency, it depends on faith. That is the watchword, not quantity, though that does come into it. Let's face it. If you're unfashionable, if you're out of fashion, you got a problem. And that's why it's 16% interest rates in Russia. They will go on a gold standard, of that I'm convinced. And when they do, just so that everybody understands what this means, it means that Russian institutions, Russian banks, Chinese banks, banks in the Middle East, and so on and so forth, can go into Western markets, buy gold where the lease rate is 2%, sell it to the Reserve Bank the Central Bank of Russia, where the return currently is 16%. And because it will be tied to gold, it's like being paid 16% in gold. That's the way in which you build reserves. That is the role of interest rates, not trying to manage an economy, which is always a disaster. So they are in a very strong position. And, I think the fact that they haven't actually gone onto a gold standard, yet is because India doesn't want it. The Chinese have a different approach to this sort of thing. As far as they're concerned, they don't want to rock the boat. They don't want to be blamed for collapsing the West, and so on and so forth. But as soon as someone like Russia goes on a gold standard, we are toast. It's as simple as that. So, and they're also talking about this. I understand that, the agenda for the BRICS meeting in, Astana or wherever it's called itself, back in October, the Russians are going to be putting, or they're going to attempt again to put the trade settlement currency backed by gold. Presumably, the word is a mixture of gold, 40% gold, 60% currencies. But they'd have to go onto a gold standard. This is the point everybody misses. So we could well have gold standards throughout Asia by October or shortly thereafter. This is an interesting situation. So how's that to start off?
Gold and silver are not just rising in value. They are becoming the preferred assets for countries seeking stability amidst financial uncertainty. The central banks are not just buying, they are strategically accumulating gold. This accumulation phase is shrouded in secrecy, with countries like China and Russia quietly bolstering their reserves. The strategic approach to gold accumulation indicates a deep understanding of the vulnerabilities in the current financial system and a preparation for a shift towards more stable and tangible assets. The concept of Bretton Woods III emphasizes a commodity-backed financial system. Countries are moving away from the dollar, replacing treasuries with commodities. This shift is gradual but significant. As Andy Schectman often points out, the move away from dollar-denominated assets is a strategic repositioning by countries wary of U.S. financial policies. This repositioning is not just a reaction to immediate economic pressures, but a long-term strategy to ensure economic sovereignty and stability. India's repatriation of 100 metric tons of gold from the Bank of England highlights a broader trend. Countries are reducing counterparty risk by bringing their gold home. This move is not just about safety, but about sovereignty. The accumulation and repatriation of gold signify a loss of trust in the global financial system dominated by the US dollar. By holding their gold within their own borders, countries are better positioned to control their financial futures and protect against potential geopolitical risks. The significance of gold's reclassification as a Tier 1 asset cannot be overstated. This move by the BIS signals a recognition of gold's enduring value. Central banks are not just hedging against inflation, they are preparing for a new financial order where commodities play a central role. Silver, often overshadowed by gold, is also a critical part of this shift. As industrial demand for silver grows, its value is expected to rise alongside gold. The strategic accumulation of silver by countries like China and India underscores its importance in the emerging financial landscape. The secrecy surrounding gold accumulation is strategic. If the true extent of gold purchases were known, prices would skyrocket. Countries have a vested interest in keeping their gold buying activities under wraps. This stealth accumulation phase allows them to build substantial reserves without driving up prices. The strategic timing of gold purchases and the discretion surrounding these activities demonstrate a sophisticated approach to reserve management that prioritizes long-term stability over short-term gains. The erosion of trust in the US dollar and treasuries is evident. Countries are diversifying their reserves, shifting towards tangible assets. This shift is not just about financial returns, but about reducing dependency on a volatile and increasingly politicized financial system. The move towards gold and other commodities is a clear indication that countries are preparing for a future where the dollar is no longer the dominant global currency. This preparation involves not just buying gold, but also establishing systems and alliances that support a more diversified and stable economic framework. Gold and silver's role in this new financial landscape is crucial. As tangible assets with intrinsic value, they provide a reliable store of wealth. The strategic accumulation of these metals is a hedge against the uncertainties of the global financial system. Countries are recognizing the need for assets that are not subject to the whims of political decisions or the instability of fiat currencies. This recognition is driving a significant shift in how reserves are managed and what assets are considered valuable. Silver's role in this shift is particularly interesting. While often overshadowed by gold, silver's industrial uses and growing demand make it a critical asset. The strategic accumulation of silver by countries like China and India underscores its importance. As the demand for industrial applications of silver grows, its value is expected to rise alongside gold. This dual role of silver as both an industrial metal and a store of value makes it an essential part of the new financial landscape. The strategic approach to gold and silver accumulation reflects a broader understanding of the vulnerabilities in the current financial system. Countries are not just reacting to immediate economic pressures, but are preparing for a long-term shift in how wealth is stored and managed. This preparation involves not just buying gold and silver, but also establishing systems and alliances that support a more stable and diversified economic framework. The emphasis on tangible assets like gold and silver is a clear indication of a move towards a more resilient and reliable financial system. For American and allied viewers, it's essential to recognize the strategic importance of gold and silver in protecting your wealth. As the global financial landscape shifts, holding tangible assets like precious metals can provide a hedge against economic uncertainty. Investing in gold and silver is not just about financial returns. It's about preserving your financial sovereignty and reducing dependency on a volatile financial system. By accumulating gold and silver, you are positioning yourself to weather economic storms and ensuring that your wealth remains secure in an increasingly uncertain world. In addition, consider the broader implications of this shift. As countries move away from the dollar, the US and its allies must adapt to maintain their economic influence. This adaptation includes not just individual investments in gold and silver, but also strategic policy decisions that support a diversified and resilient financial system. By staying informed and proactive, American and allied viewers can navigate the challenges of the evolving global economy and secure a stable financial future.
If you want to stay most up to date on the silver and gold markets, make sure to subscribe to my daily 5-minute silver and gold newsletter. It provides the latest expert insights, breaking news, market trends, and investment strategies, all in a concise format. Click the first link in the description to join thousands of others and enhance your investment knowledge right now. If you enjoyed this video, please give it a thumbs up and subscribe to my channel. Your support helps me stay motivated to bring more valuable content to you. See you in the next video.